Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome, Ben. I am excited to have you on the market update today for Westside Investors Network. Ben Murphy is a commercial real estate broker and we've done 10 or so deals with Ben here in the Portland Metro. And I'm excited to have him on to chat about the current market conditions and also discuss past cycles. So, Ben, why don't you share a little bit more about yourself and give us your thoughts?
Thanks, Chris. Yeah, it's great to be back on. I think I'm kind of becoming a little bit of a regular here, which is pretty fun. So Ben Murphy, I've born and raised in the Portland area, grew up in Tigard, and I've been a commercial broker close to 15 years now, multifamily investment sales, middle market. So kind of that 30 to 100 unit range is where I like to be. So sub-institutional, but typically not down on the plex level or, more residential side. So kind of in between those two. And I'm also an investor. I own a little bit shy of 50 units, some duplexes, fourplexes, a couple of eightplexes. So I can kind of look at the market from the lens of an investor and an owner and an operator, as well as a broker. And then I also have a lot of experience, obviously, working with management companies like Uptown Property Management, for example, and other third-party management firms in the Portland MSA. So, yeah, that's a little background.
Yeah. Ben and I have had many conversations about this latest cycle, which kind of started, towards the end of 2021 and really started moving when inflation started peaking out in 2022. And so, there has been some significant, drops in value. NOI is compressed. Expenses are up. I guess that is part of NOI being compressed. But all in all, this has happened before. And so I'm most interested in hearing about what the opportunities look like and, what is kind of coming down the pipeline. We've probably spent close to 4 years at, kind of lower sales activity. Property owners have their 5-year fixed or 10-year fixed mortgages kind of locked up. And so they don't want to move their properties. But now, that 5 years is up for everybody who refinanced in 2021, the market environment has just changed. And so I'm interested to hear from a commercial broker side, just perspective of like, okay, well, what does it look like for sellers? And then, what have you been noticing with rents? What have you been noticing with just NOI and essentially buyers projecting and underwriting, on an acquisition? Like what does that look like for deals that are happening? And is sales activity picking up? That's an interesting question as well. So I'll let you go on a short monologue and then we'll start asking each other questions.
I hope it's short, Chris. So here we go. I guess speaking to the market in general and transaction volume, I won't sugarcoat it. I'm a pretty transparent guy when it comes to commercial real estate. I like to be upfront with my clients and really realistic about the market. Why avoid the elephant in the room? My volume is probably 30% of my normal peak transaction volume. So it's down 70%, I guess is a better way of framing that. Has that picked up in the last 6 months? Yes. So that's the good news. Has it picked up by much? Not really, but an increase is better than no increase. And I think we are troughing out. The market, I think, is, peak to trough. I think 2026 will be the lowest year on record for sales volume in the Portland MSA. I sincerely believe that. And I think.
So you're talking about the trough on sales activity.
Correct. I think 2020 to 2021 was kind of the peak. So we're coming up on that 5-year mark. This has gone on a couple years longer than I think a lot of people anticipated. And I think there's winners and losers in every down market, right? I think it's a great time to be a buyer. I think there is true motivation hitting the market with certain seller profiles in the Portland area. And that fits a buy box for a lot of people who are opportunistic buyers. If you want to peak the market, like if you want to time the market and peak pricing as a seller, right now is not a great time. I mean, you hit on it. Rents have been relatively flat, although in the last 6 months on the rent surveys we're doing, we are seeing rents are up about 3%. So that's the most rent positive direction we've seen in 3 or 4 years. I mean, a 3% growth rate over 6 months, 6% annual, that's nothing to write off. That's not back to the 10 to 12% annual rent growth we were seeing in 2014 through 2020. But that will be a hard market to ever replicate again, I think. So again, rent growth is positive. It's not stagnant like it was 6 to 12 months ago. Transaction volume is up slightly. And I think the big concern right now is operations. Owners are really, really having to focus on their expenses, specifically turnover, R&M, insurance. And if you're in a revolving door of turnover, vacancy, loss to lease due to lots of move outs and then re-renting taking time and turnover really being over budget, it's going to grind away your NOI, like you already touched on, Chris. So I think the rents are at the end of the day, if your property is well managed, the rents are the rents. I don't even look at that often as a variable you can really control, right? If a tenant likes the unit and it's comparable to the neighboring unit, they're going to rent it if it's a fair price. But expenses, to a certain extent, you can control if you're really diligent about it. So I think this phase of the market over the next year, that's where owners and operators and management companies should be focusing their attention. I think that's where more of the upside is as far as growing NOI. I think I answered most of your question.
Yep. So you're seeing positive rent growth. I mean, last summer we saw like a decent decline in rents, which was really tough because we were having the same conversation last year. Like, okay, it's been 3.5 years. Like this one can't be as bad as the Great Recession. And essentially we got hit with decent rent decline. Like looking at some of the rent data, if you look at year over year, I mean, we're basically flat from 2021. We got huge rent growth from 2021 to 2022, and then like essentially we're flat. And nobody predicted that. All of the deals that I underwrote, I underwrote steady rent growths, and in some areas of town, we've seen deals that got maybe the rent roll got inflated by government like subsidies or, essentially free rent being paid by the government. But, a couple of properties that we bought, like they were averaging $1,500-$1,600 a month in rent. And then, now we're at $1,250 or $1,300. And it's, and occupancy is low at those properties. And so I agree. I don't think that we're ever going to see, essentially that period from 2016 to 2021 again, where interest rates were low, rents were off the charts, and essentially it was a gold rush here in Portland. Where, how many apartment units are in Portland? Is it something like 40, 50,000, 60,000?
I was going to say 50,000. Yeah.
Yeah. When all of those units go from averaging, maybe like 100,000 a door, maybe 120,000 a door 10 years ago to now averaging, 200 or 225, like that is a massive increase, and likely to overshoot. And so we did overshoot a little bit, I would say.
The market's being reset, right? And I don't think that's necessarily a bad thing. There's a new baseline that has been established, and I think we will incrementally claw back values. I really do. I think the big, question that if I knew the answer to, I would be doing very well. But is when will we get back to peak values that we saw in 2020 and 2021? And I don't think anybody really knows the answer to that. They will claim they do. They'll shoot you data on this, vacancy, rents, cap rates, interest rates, what have you. But I wouldn't be surprised if it takes 3 to 5 years to get back to the peak that we saw. And I think you hit the nail on the head, like, Chris, the pandemic era stimulus we saw and the COVID area, like rent guarantees, along with relatively flat expenses and generationally low mortgage rates. It was this trifecta of
low inflation too.
You can make mistakes and still do well on a deal. So this market is weeding out the bad operators and the people who don't have really well thought out, thorough value add plans. And that's not necessarily a bad thing. And, 10 years ago, a lot of syndicators and, sponsor type buyers could go into a deal and kind of just do anything and look like a genius. And really they're just riding the market. And they should be. There was a lot of money made in that market by brokers, owners, management companies, lenders, everybody. So I think now it's just it's a baseline reset, and it's compelling. There are deals at 50% of replacement cost on the market that are still not. They don't have a stack of offers on them. It's mind blowing, and that's mainly in reference to newer product in the city of Portland, core plus, adjacent, to downtown. And that's probably the worst tranche to be in right now as far as multifamily in Portland.
Honestly, though, I feel like that's going to come back first. That, they're like condos, I feel like in downtown are going to trade, at well below what they were purchased for. And, there's going to be a revitalization, but at a much lower cost. Like that, Portland is always there's always a reemergence of the artist, the starving artist community that is essentially looking for the lowest possible rents on the West Coast. And, Portland was not that during, the 2016 to 2021 run up. Now that I would say San Francisco is recovering, Seattle, I would say, has recovered, and Portland, always kind of lag behind. And so I feel like there's that kind of going for it, is that Portland is always the cheapest West Coast city with a ton of beautiful natural resources, just kind of like looking at it from a macro level. And then when you look at it in terms of, I guess, from an investment perspective, prices are significantly lower for anybody who has to trade a deal. It's you're looking at cap rates much higher on the acquisition than you were 3 or 4 years ago. I mean, we're talking like the difference between 4.5 and 6.5. And I mean, that's, and it's tough to, I don't know if we'll ever see 4.5% cap rates again, except for, distressed deals, and
Yeah.
when you look at it, acquisition rate.
Portland is affordable. We can hang our hat on that, especially compared to the other metros on the West Coast. I think the other supply side argument is just the barriers to entry we have. That, like, the inclusionary zoning product that was, people sat on permits forever, and a lot of that delivered over the last 2 years, and it's completely dried up. So you look at new units in the pipeline, and it's 5% of what, like, Portland historically had 8 to 12,000 units delivered to the MSA every year for like a decade running. And I think currently there's 1,500 roughly. In
The MSA, or are you talking city of
the
Portland?
Tri-County area. So that's not just Multnomah County or city of Portland. That is, 5 to 10% of what we've normally seen come online every year over the past decade. So rents have to rebound purely from a supply side, stance.
But the supply side argument is like, that's really long dated. There's so much vacancy that needs to be absorbed.
This is true. We overbuilt like nuts because of what they've imposed on developers. And these guys are smart. They got in and grandfathered in their permits prior to a lot of this red tape being passed by the city of Portland. But if people tend to get tunnel vision when they're investors in the Northwest, and they think the Northwest is like everywhere else in the country. But if you go to Austin, or you go to Raleigh, or you go to Nashville, and some of these other areas of the Sun Belt, their rents are down 10, 20% year over year.
Yeah.
Right? And we're complaining about flat or slightly positive rent growth. So it's all relative. Not to say our market isn't struggling. It definitely is. But it's not to the level of some of the other regions that have had even more severe overbuilding happen in the recent term. And that's one thing I've always really thought is such a selling point to investing in Oregon and the Portland area and the Pacific Northwest in general, is it's a very consistent market as far as rents when you compare it to other regions of the US. It doesn't have the boom and bust cycles like a Phoenix or a Nashville or an Austin. Yes, we have ebbs and flows in the market, but not nearly to the level of some of those other markets. So
that's so interesting to hear. And I mean, I guess, like, I feel like the boom and bust cycle for us as multifamily operators, like, really was significantly felt in Portland. But yes, like, I totally hear, like Phoenix, weren't 2-bedroom rents like close to like $2,300 or $400 a month, and then now they're like down to $1,800. And I mean, it's, I could imagine getting into that market at the wrong time, and that your capital is gone. Like, it's a little more dangerous.
it is. And that, in a market like Phoenix, that's market wide. You will see that generally in all vintages and asset types. In Portland, the urban mid-rise luxury style product is hurting. I will not get, we won't sugarcoat it. There's 2 to 3 months of concessions in some of those buildings. So if you actually annualize out those concessions, and then factor in the rents really aren't flat. The face rents are flat, but the effective rents are down maybe 10%, right? When you annualize out concessions or more.
Concessions, and I mean, so we're in contract buying a home forward, like a legacy asset, 10 units that's getting removed from the income restricted portfolio. And like their take is that it's too expensive to run that type of property anymore. And so they're buying up this cheaper product cheaper, relative, like new construction versus building it. And essentially, I think that if you look at how much vacancy there is, even in the home forward portfolio, these income restricted, the new construction units, they're offering the same concessions that market rate developers are offering. And so if you look like on a home forward website, you're seeing income restricted rents plus 3 months of concessions. And when you're trying to compete against something like that, market rate, it's extremely difficult because, their rents are lower and they're offering, plenty of months free. So it's tough to compete, to win tenants to occupy units. Like it's a battle right now. It's really tough to get units filled up.
And I think it's tough to qualify too, because a lot of those tenants' income qualifications, they make too much. So you have a very finite, you only have so many renters to go around in those home forward buildings that actually qualify. And let's be honest, would you rather rent in a market rate building or an income restricted building if the rents are equal? Right. So I think that's what people are looking at right now. And it's good to hear home forward is buying existing product and not developing it, because they can buy that at a discount. And that's a better use of our tax dollars, in my opinion, is buying existing. I think the last one they built was $457,000 a unit.
Yeah, that's pretty expensive.
Yeah, and some of that you can buy for 200 to 250,000 a unit today. So you get 2 units for the price of one. But we're trying to sell a multi-deal, which is an inclusionary housing, 100% inclusionary housing deal at 60% median family income. And the studio rents for an equivalent unit are about $50 higher than the income restricted building. So you're right, Chris, the rents are almost the same. So the occupancy at this affordable deal is like, it can't get, like, they're struggling to push past 85%, and they're offering a month free.
Yeah. Yeah. And so I guess I'm interested. When did you get started in commercial brokerage? When
2011.
2011. And so when you look back then, we were coming out of a pretty difficult period of time, like 2009, 2010, 2011. Like sales activity is probably what it is about right now. And so what do you remember about that time? And just looking back, do you sense any similarities? Like, is there the same amount of, I guess, motivation for sellers to sell? Is there like the same difficulty when it comes to operations?
Capitalization rates were higher coming out of the great financial crisis than they are today. And they had to be to get buyers to move off and sign a deal and do an acquisition and actually commit, to applying for a loan and financing. What's interesting right now is like the basis has become compelling in a lot of cases over the cap rate. Price per unit, price per square foot, That's kind of like a basis buyer versus a cash flow buyer. And I don't necessarily know why that is the case now more than it was in 2011 or so, coming out of the tail end of the financial crisis. It feels to me like there's definitely still pretend and extend and loan modifications happening in this market where the can is getting kicked down the road a little bit farther, but I think that can only hold up for so long. And I really do think there's second, third, fourth extensions or loan mods or whatever that these borrowers and sponsors are trying to negotiate with lenders. They're just going to finally throw up their arms and say no, because we haven't seen the distress that we saw,
Not at all.
15 years ago, not anywhere close. I think there's a handful of like Class A apartment buildings that maybe had like a short sale-ish type situation go on, but not the level of intrinsic, like full-on distress that we saw 08, 09 in the next year or so. So, but Chris, I still think some of that is coming. And I just think lenders are really reluctant to step into the borrower's shoes just yet. And our memories are short. I think they're in denial. They are not in tune with operations. They probably think they're being, they're listening to what they're being told. Oh, we'll turn this property around. Rents are going to rebound. We'll get them back in the positive, and we'll get expenses under control. Concessions will burn off, but concessions are way more entrenched than anybody will admit either. So yeah, I think if you're not operating through this with really a fine-tooth comb and experienced in operating, you're gonna have an issue with your loan. It's unavoidable. If you can't handle a rate reset to 6.5% in the next couple of years, I don't know what to say. I think there's gonna be buying opportunities. I sincerely believe throughout 2027 that we'll have more distress involved than we've seen to date.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
So I wonder if there's going to be distress, and foreclosures. I honestly, so I feel like there are groups that are connected with lenders who just pick up properties and they just kind of get them. And the bank is like, okay, we're taking the property back, and then they give it to somebody. Like, or there's sponsors that are like, okay, we just can't do this anymore, and so we gotta, we're just gonna let this other team take it over at the like lending basis, and they work it out with the seller, and it never hits the market.
Or they raise pref equity, right? And they kind of recap the deal and live to fight another day. And I think you're right, Chris. I think lenders are more accepting and creative than they've ever been in the past with.
Uh-oh. Ben, you there? Oh, I lost you there for a second. It froze for a minute. So you're saying that lenders are more creative.
Yeah. And I've heard of a couple of instances where the sponsor, the borrower, has actually bought their own deal back.
Yeah, from their investors.
Yep.
Yeah. That is there's interesting stuff that goes on. And so like I would say a lot of that distressed product, especially if it's something worth buying, it probably never sees the market. Or maybe just a fraction of it sees the market, because there are plenty of people who want to get in on the reset, and I agree that there's a reset happening. And when you first mentioned that, I guess an idea popped into my head is that like there's going to be winners and then there's going to be losers in the reset, like especially all around the Portland metro, and so it'll be interesting to see kind of like how that shakes out. And like I wonder if you have any idea of like what like areas you think are going to come out stronger versus some areas that are going to come out weaker.
Yeah, as far as submarkets or I would say the strongest markets, I think, in the long run, I try to avoid like 1 to 2 year sort of time horizons, because it's just there's a lot of unknowns and it just puts me on the spot. But I think Clackamas and Washington and Clark counties are really kind of three generally really strong areas to be. So Beaverton, Hillsborough, Tigard, Lake Oswego, Oregon City, and then up to Vancouver, Southwest Washington. I think anything downtown or downtown adjacent, Gresham, Troutdale, East County, East Multnomah County is really going to struggle in the long term. And Portland will always be a cool place to live. It will recover, but it won't become what it was prior to the pandemic. I think there's damage that has been done that is irreversible. I think it will come out of this better than it has been the last few years. But there's a stigma there, and we're seeing a flight to these suburban nodes. I think, there's food cart pods in Beaverton and Cedar Hills and downtown Oregon City and the Vancouver waterfront, and they've become their own little enclaves. Outside of Portland. Not to say and there's also amazing nodes in Portland, like Division and Alberta and Belmont and Hawthorne. So again, I think the unique, cool neighborhoods have become more concentrated and more exclusive, and you have to find those areas, and those are the good areas to invest in the long run. And I think the east side of the MSA will struggle, in addition to downtown.
So, in around 2014, 15, 16, being in the beer industry a little bit, there are a lot of interesting breweries that went in downtown. 10 Barrel went in around that time. Von Ebert had a pretty huge tap room, and those have all I guess 10 Barrel's still there, but there's many like breweries, restaurants that have kind of come and gone during this time period. And I feel like that for that to come back, it just takes time. And when you speak about the permanent damage, are you talking about people working downtown and working remotely, and just the structural change of what are our inner cities going to look like?
Exactly. I think that to really solve the downtown CBD core business district crime and homelessness and businesses struggling is we just need more bodies down there, and it will snowball from there. That chases away a lot of those issues. So
Yeah.
until we
reasonable people won't stand for crazy people, disrupting, life, when it's one or two people for, thousands and thousands. And so yeah, it does need more bodies. But the question is okay, nobody's working downtown anymore.
Yeah, and I think people are hesitant to dip their toe and be the first one to really lead by that. I mean, what should happen is the city of Portland and Multnomah County, who can require that, should lead by example. Because there's tens of thousands of employees for the city and the county that used to work downtown that are either fully remote or mostly hybrid. And I think that would be a logical first step if the city council or the mayor can get involved and, have some input and say, hey, like, start there, right? And I think, hopefully private businesses and, adjacent businesses to those locations will kind of see that example and also follow suit. But again, you're right. It takes time. It's not, a year or two out, I don't think we're going to nearly be back to anywhere where office occupancy levels were at the peak. And I would say if you factor in shadow vacancy and sublease space downtown, it's over 50%. I think CoStar says it's like 38 or 40, but that doesn't, if you drive around, everything's dark.
Yeah.
So I think it just has to be long-term, and we have to do our best to sort of navigate and incentivize traffic.
Okay. So downtown's going to struggle. East side's going to struggle. You think the winners are going to be, to me, it seems like Clackamas in general is really a big winner. And then, we're seeing a lot of activity in Vancouver and Clark County. I kind of look at Clark County and I'm a little hesitant to have that trend confirm. If you look at rents in Vancouver, they have gone up significantly. And so that's a harder one for me to just this market's taking off, we better jump in.
Vancouver, you should have been there 4 years ago.
Yeah.
It is, the secret is out. Rents are very soft. Concessions are way up. I think of all the submarkets in the Portland MSA, Vancouver's in the top 3 for highest vacancy. I want to say it was 8.5 or 9%. So they've had a ton of units deliver in the last 8 quarters as well. Not only in the downtown waterfront area, but market wide, East and West Vancouver, up to Hazeldale, over to Camas even. So I think what people love about Vancouver is it's not Portland. and I know that sounds crazy, but Washington State has its own set of rent control and landlord tenant law that's not, and maybe you can shed a little more light on this, Chris, but I don't think it's that much easier to navigate than Oregon's laws.
It's
at this point.
Yeah, and I would not call myself an expert on Washington rules. So when I'm having to send a rent increase or implement RUBS or send out a notice, I'm having to look up the rules.
Well, I can tell you 6 months rent increase or 6 months notice for a rent increase over 3% is, I believe, a Washington state law.
Wow.
Which that is much more anti-ownership.
That's not that big of a deal. Yes, it makes it harder to, move something quickly if it's under market rent. But all in all, you can just send out large rent increases and give tenants 6 months notice. I mean, in Oregon, the statewide rent control law, like, is getting ratcheted down. Like, and it's worse. You know, it used to be 10% plus CPI. Now it's 7% plus CPI. But, you know, now you can only raise rents 10%. And then, you know, you can kind of see the trend line on the rent control here. You know, we're going to be like capped at 5% here pretty soon. It'll probably be capped at 7%. You know, next time rents start moving up significantly, like next time people see 10% rent increases, it's going to be capped at 7. And next time people see 7% rent increases, it's going to be capped at 5. Like, that's essentially where we're at. Like, it's a renter state. But the thing is that, you know, then that is just going to be market wide. Everybody's going to be issuing full rent increases while we can.
Yeah,
And
you can't afford to fall behind market because you won't be able to catch up. So everybody will be more proactive about their rent increases. And then when units do turn over, the new tenant who unfortunately had to move for work or medical reasons or to be near family is going to be subsidizing the existing tenant who's locked in lower increases over the last few years. So it's an interesting approach to regulating rents and cost of living, but the West Coast is doing it to a larger extent, you know, in lockstep. Each market has their own form of it, and that's likely not going away anytime soon, right? Let's not kid ourselves, Chris.
I mean, if you look at a market like New York right now, I mean, New York is on fire. Like, and you know, rent is not low there.
It's not low, and they are having a resurgence, right? As far
Yeah.
as quality of life, employment, you know, restaurant scenes. I think, I guess that is a beacon of hope in a way to say, like, look, this city of Manhattan, the city of New York, whatever you want to call it, one of the highest tax districts, but in front of Portland in the country, is, you know, I think we're number 2, but is still a great place to live. So take that for what it is. But I think people find ways to navigate around it. And usually what it ends up doing is it hurts the person who is moving in more recently than the person who's been in the building for a long time. And I don't see how that's fair, but
Yeah. All right. Let's chat about rents real quick, and then let's end with our 4 questions. So I guess looking at rents from, you know, say 2014 or 15 until now, I mean, the way that I see the chart is, you know, rents were probably averaging around 1,500 for a 2-bedroom up until, you know, say 2020. And, you know, like, honestly, during COVID, rents actually went down a little bit. And then it shot up to like 1,700. And so, you know, like, we go through this period where rents are completely flat or maybe tipped down a little bit, and then it spikes up. Like, honestly, I feel like the spike up was probably around 2014 or 2015. I don't have the data that early, but like, we were probably hanging out at like 1,200, you know, all of like 2011, 12, 13, 14, and then poof, like, and then we shot up. And then we hung out at that level, and then, you know, something happens, you know, COVID happened, and then rents shot up. Like, I think in 2014 or 2015, like, we hit like, there was just no supply, and that's what caused the eventual rent spike across the MSA. And so, are we going to see that again? Like, are we going to hit a supply, like, just a lack of supply due to the permits not lack of deliveries, or or is there going to be like a little steady tranche of deliveries to keep us from, getting down to that, 2 or 3% vacancy that we saw, in 2014, 2015. Like, or, I mean, I guess from the way that I see it is, it's so expensive to build something. And for the return on investment, the rents, like it just doesn't make any sense. Like, how can you expect to make money on a unit that costs $400,000 and only receive $2,300 or $2,400 a month in rent when the debt on that product is going to be 6.5 or 7%? Like, it's just really tough to kind of figure out how that's going to pencil. It doesn't look like interest rates are going down.
Renovated product in the suburban Portland area for like 60s and 70s and 80s vintage apartment buildings was getting close to $2,000 a unit on a 2-bedroom up through 2020, 2021.
Yeah.
And yeah, 8-9 years prior to that, it was probably 1,000. So you saw rents double, right, in a span of, let's say, 8 years. I don't think, if you were to tell me 2026 to 2034 and rents are 1,500 now, and you're telling me rents are going to be $3,000 in 2034,
no,
I don't feel confident. Again, I hope I'm wrong. Again, I'm a multifamily broker, and that would be great to see, true, like,
there would be other things that are broken if that is, you probably wouldn't be able to get a loan because, inflation is literally,
yep.
We would hit hyperinflation, I feel like, at that point.
So my point in making that statement is, like, pare that back then. Is it half of that growth rate? So, maybe we see rents go from 1,500 to
I think you're highlighting the
2,250
edges of the bubble there. Like,
yep.
We were buying stuff in, I don't know, 2014, and like they were literally units being rented at like $1,100 a month.
Yeah.
And these were 2-bedroom, 1.5 bath townhomes. Like, we bought an 8-plex, I think, in 2014, and we renovated the units, and and now they rent for like $1,700 or $1,800.
But at the peak, they were renting for maybe $2,000 or $2,100.
We never got that high. I guess we
Okay.
never got that aggressive with it. I think that we're down to like $1,695 now. But the entire MSA did not get rented out. Like, the entire renovated MSA did not get rented out at $2,000 per unit. Like,
No, that's a good point. I was looking at the severe extremes of,
Yeah.
Somebody coming in fully gutting, remodeling something, and
Yeah.
pushing market like rent really aggressively. And it was typically like an out-of-state syndicator who was kind of a shorter term hold that was really pushing the envelope. But I think, to answer your question high level, I think we will see kind of 3 to 5% rent growth the next couple of years. Unless you have a property that's very far below market that has some kind of special story that was mismanaged or not operated efficiently.
We're going to see $2,000 rents in the next 10 years for that. Like, if I would say average 2-bedroom rent is probably like 1,550, maybe 1,600 right now.
Yeah.
And like, I would say we never really got to the $2,000 rents, and like that's basically like just below where Seattle or 2,000 would be, or right below where Seattle or San Francisco are at right now.
Mhm.
And I mean, I honestly think that, yeah, we are going to get there, probably closer to 5 years than 10. I mean, if you just pencil out 3% rent growth, 4 or 5 years in a row, then
that tracks. I mean, you said 25%, 5 years, so that's 5% a year. I said 3 to 5%. So I could see rents growing 1,500 to 2,000 on average over a 5-year span. Yes,
Yeah.
I think that's realistic.
Yeah. And, I guess the question is, what is the cap rate environment going to be in 5 years? What's the interest rate environment going to be? And you get these like little selling windows. I swear, every time around February or October, the interest rates dip and good deals can be had. If you get a application in, but you got to be poised and ready to sell.
Yeah, interest rates are a big. I hate the forward guidance of the Fed because like a lot of it's baked in, depending on like a simple Fed meeting or what a few sentences somebody says often. And it'll be interesting to see what the new Fed governor, who really wants to pare back forward guidance and kind of how that I don't want to say manipulates markets, but the global order could be shifting too, right? We have a lot of geopolitical shocks and risks going on right now that are making the markets super volatile. And if the US really does turn inward and become a little bit more protectionist and the global order changes, and free trade is kind of at risk, and the US as a reserve currency in the long run is being questioned. I mean, I think we could see elevated interest rates. I'm not saying we're going to see 10% rates, but I think the days of us seeing 3 to 4% rates are behind us, and those might have been generationally low borrowing costs. I do believe that.
I don't disagree there. And so, you're going to get a lot of people anchored towards those low rates. Like, maybe thinking that it's going to come back eventually. Like, we're going to see 4% interest rates, one of these days. And I think we're going to be lucky if we see 5, little windows where there's 5% rates available. So, yeah. All right. Well, Ben, we are getting on towards the hour mark. Chatting about the market. I guess can you summarize your sentiment about like essentially having started in 2011 and experiencing that huge run up and then going through kind of this reset, like, and then and maybe anything else that you've learned from mentors or others, like what do you think the keys to, I guess, surviving this cycle and poising yourself for success forward would be?
I think to the extent you are really in tune with operations, and I'm going to sound like I'm beating a dead horse here, but watching the costs that you can control on the expense side, specifically R&M turnover, and doing whatever you can to retain tenants, good tenants who are paying rent on time, and avoiding, the revolving door of move out, chasing tenants, vacancy, loss to lease, potential concessions. And if people can incentivize good tenants to stay in their buildings longer, they will get through this in a much better position, especially with the pending refinance or a capital call on the books from low interest rate debt to higher interest rate debt in the near term, which a lot of people know what I'm talking about in your audience, I'm sure. So operations, managing expenses, and I think treating your tenants well and your residents in a way that is unique and genuine is something that isn't talked about enough in our market. There's a lot in the news cycle out there, and that, owners and operators are out there just to jack up rent and rehab a unit or relocate tenants. And very few of the people I talk to and the investors I talk to ever want that. I think they want to provide safe, affordable, well-maintained housing at a fair price, and they're not out there to make a quick buck and get out of a deal at the expense of somebody else, right? And sell it quickly. And so I think the service element in the rental market we're in currently is a good way to delineate yourself compared to other property managers and operators. And I think it goes a long way. And it doesn't take a lot of extra capital to provide that. I think you just have to have the right, methodologies or I guess the right training in place for your staff, the policies and procedures to show that you do care, and just have that dialogue with the residents. I think, having that dialogue more often than not, so they don't feel like they're being taken advantage of or something's coming out of right field, can really help in this rental market, where people do have more choices than they've had in a long time as far as options to rent elsewhere.
Yeah. And so what about for buyers and sellers? What about for the person who maybe hasn't bought their first deal yet, who's trying to get into this market, but is struggling trying to find the right deal? And then what about the property owner who has completed their value add on a particular property, and it's time to move that capital to another project where they can add value?
It's funny when I talk to buyers, because the 9 out of 10 are seeking a value add reposition. There's an inefficiency that needs to be solved. And I get it. I mean, I think if you're raising equity, investor dollars, you have to have a story. There has to be a pitch. I would say listing for sale like a value add stabilized deal today is challenging, because you're like, I need to show a buyer, maybe if a lot of the upside's already priced out and the property's been repositioned at market rents, I usually need to show a buyer who I'm pitching to buy that deal 50 to 75 basis points of positive leverage. And if, borrowing costs are 6 to 6.25, that means my cap rate is 6.5 to 7, right? And I think most owners aren't sellers at that cap rate today. And they may need to wait it out a year or two till we get to a market where there is a little bit more cap rate compression.
And so that cap rate compression is going to come when rents increase. That's but before that hits the NOI. So yeah, I think that'll be a good signal to kind of see essentially when the market starts to pick up. Well, Ben, it's been a lot of fun having you on. Thank you for chatting, and yeah, it's always good to hear your perspective.
Thanks, Chris. Yeah, it's always a pleasure. It doesn't even feel like we're talking shop, because we've done so many deals together. So I appreciate the opportunity and hope to see you again soon.
Cool. All right. Well, that's a wrap.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.